Okay, it looks like we don't have people joining every few seconds now, so we can go ahead and get started. I'm Rachel Robasciotti, the founder and CEO of Robasciotti and Phillipson, and the co-founder of RISE, which stands for Return on Investment in Social Equity. And on behalf of the entire RISE team, I want to welcome everyone who's here and to let folks know that we have clients, we have fellow ally investment managers, and some folks from our social justice partner organizations joining us. So it's truly a community event, and we'll try to give as much context as we can as we go along so that everyone's on the same page. And 2 weeks ago, Robasciotti and Phillipson, the parent organization, we offered community office hours to our clients, and it was really wonderful to be with everyone in the midst of market volatility and so many unknowns. And we decided that it was so successful that we wanted to offer one of these again. That mostly had a format of questions and answers. And today, because it's a RISE community gathering, we'll take just a slightly different format. We're going to have the whole RISE team introduce ourselves. Then I'll give some framing for what we're up to with RISE and where things are at present. And then we'd like to open it up to, instead of Q&A, to questions and comments. Because at a community gathering, sometimes we're saying things because they're a question and we want to direct that question kind of at the RISE team. But sometimes we're actually speaking up because it's just important that we're heard in the space that we're in. And we want to give space for that as well. When there are questions, I'm going to leave a bit of space so that other members of the RISE team can step forward and speak to any questions. And if no one's speaking to any question in particular, I'm always happy to jump in and speak to questions that might be asked. Okay, so let's start by introducing ourselves on the RISE team. So I'll model it. We're going to do our names, pronouns, titles, and roles. I'm Rachel Robasciotti, as I said earlier, the founder and CEO of Robasciotti and Phillipson, and our impact investing strategy is RISE. I'm the co-founder of RISE, and I use she, her pronouns. My role at the firm has to do with managing the overall strategy, as well as being the spokesperson on behalf of our work in various different communities. And I will call on Rachel Freeman. And Freeman, you can call on whomever else on the RISE team when you're done. You're muted. It is true. Let's unmute you.
Thank you. Told me that I was good. I didn't know like a good sign for that. Hi, good morning. Rachel Freeman here. I use she, her pronouns. The other Rachel's OG Rachel. You can call me Freeman if you like. I'm the director of RISE Investor Services here at Robasciotti and Phillipson, and my role is to manage the client relationships. I do a lot of like new client introductions to the RISE portfolios, and also sort of manage the business development team here at RISE. Popcorn Fong.
My name is Fong, and I use she, her pronouns, and I am the RISE investment strategist. And in my role, I help decide what companies we do or don't invest in based on data we source from our social justice partners and organizations. And I'm excited to be here today. Thank you for joining us.
I'm Renee Morgan. I use she, her, or they, thems. I am the social justice strategist, and so I work particularly with our social justice partners in getting their view for how to direct our investments, representing communities that are most impacted by some of the ills of our society. I see potentially one or two clients. I also am relatively new to Robasciotti and Phillipson and brought some of my clients over. So I'm happy to sort of see you. So I'm also a financial advisor as well and have been for about 20 years.
Hi, I'm Elizabeth. I use she, her pronouns. I am Rachel's Robasciotti's chief of staff, and I help her with the RISE team and a lot of our marketing communications and other organizational needs, and anything else that might come up to support the team.
Wonderful. Thank you, team, for introducing yourselves. I really do work with the best possible team for RISE, so it's really a joy and lots of fun to be on the call with you and everyone else in our community. So I just want to provide some framing for our time together. We'll be together a little under an hour in total, and because there are people who are at different points of entry with RISE, just wanted to provide some framing for why we're here and what we're about. At RISE, we believe that impact investing should be accountable to the communities that are impacted by our investments, which is somewhat of a novel concept in our industry. And we also believe that social justice movements and impact investing are most effective when they work together. So we serve as a bridge between social justice movements, specifically those that are by and for impacted communities, and values-aligned investors. So we facilitate investors and social justice movements joining forces in what we believe will become an unstoppable set of agents for meaningful social change. And we create investment portfolios that earn what we call a morally accountable and financially viable investment return. The last thing that you should know about us is that we use something called restorative investing to drive large-scale systemic change for the good of people on the planet. And when I talk about restorative investing, I'm really referring to the fact that between the extractive economy, where different actors are extracting maximum value from one another, and resources get concentrated in the hands of some actors and not others at the expense of those others, and between that and the regenerative economy, where our economy works for all of the different participants, and is actually in a regenerating model that is not extractive. In between there is transitional capital, and that transitional capital is restorative. And what restorative really means is that we're using the systems that exist and putting them in service of the agents of the regenerative economy that we're moving toward. And we believe that those agents are those who've always had the best answers to the world's problems, those who are most impacted. So that's a bit of a sense of why we're all here together and kind of our format. The thing that a lot of people have questions about is kind of what's happening in the economy. You may have heard today that we had 6.6 million people apply for unemployment. Just as a point of reference, over 650,000 people applied for unemployment in 1 week. That was the record in the 80s. And so having 6.6 million is an order of magnitude higher than that. The week before, we had 3.3 million people apply for unemployment. So we're looking at, in 2 weeks, 10 million applying for unemployment. So this is a change in our economy and in our employment picture of really historic proportions. And we've seen the impact that that has had on financial markets. Interestingly enough, a few weeks ago, the market had a lot more turmoil than it does today. Today, the markets are trading slightly positive. At the last check on Wall Street, the financial markets are trading slightly positive. And particularly because there's some news about a Saudi-Russia oil deal. And so one of the things that shows us is, in a certain sense, how out of contact the financial markets are with the impact on real human beings, those who are most impacted by this particular crisis and are most impacted by all the ills of the extractive economy that we live in right now. And so just wanted to speak to that, and also to let people know that in the RISE portfolio, we exclude actors that don't meet our standards that we source from impacted communities for corporate behavior, and we help those impacted communities set the standards for corporate behavior. So I'm going to leave the space open at this point for questions and comments from any of the group, of any one of the folks that are here, whether you're a client, an ally investment manager, social justice partner. We'd love to hear from you, see if you have questions or comments. And also from the RISE team, you may also speak into the space. Looks like we have someone that's turning on their video.
Hi, I'm Eva. I'm a client of Renee's and happy to be part of this group, and so glad that you're doing this. Are you all still saying stay the course, hang on, this is going to get better if we give it enough time, or are you beginning to rethink investment strategies?
That's a really good question. And I'm just going to leave some space for anyone on the RISE team that might want to speak to that, with, of course, me as a backup.
Yeah, Rachel Robaschotti's drinking water, so I'll take this one. Hi, Ava. Great to meet you, Rachel Freeman. That's a great question, and I think it's something that we get constantly. Renee is probably like, oh, I've said this to you a couple of times, but I think sort of in the scope of why people hire financial advisors, the number one reason that I always remind folks of is like that it's very difficult to remove emotion or to stay unemotional around your own money. And a lot of people do it themselves, and they do a great job until there's turmoil. And so that's part of what we're really here for, which I'm sure you know, because you've worked with Renee for so long. But something that we really just always are considering is that we're trying to move the needle for publicly traded companies. As Rachel mentioned in the beginning, is we're really working towards bringing the extractive economy more towards restorative and restoring the stock market and the publicly traded space, and then eventually moving to that new, hopefully new economy sometime down in the future. And I think that when we're thinking about changing investment strategies, our firm as a whole really sticks to the philosophy to stay the course, and especially in times of turmoil. So that's why we're here to hold hands for clients, and we make it a point during times of turmoil not to change that course, so that we can continue to influence these publicly traded companies. But yeah, it's difficult. It's difficult for all of us. It's definitely it turns your stomach upside down for sure, but we're not planning to change that philosophy. As long as publicly traded companies are around, we will still have extractive companies that we're trying to invest in and influence. And so we need to kind of do our part in that column, and then to continue to make space for that regenerative economy. That's our philosophy. So does that answer your question?
Yeah, I'd like to add a bit to that. Thank you, Freeman. I was talking to a client last week, Ava, who asked a very similar question. And there's within that question is kind of is this time different? That's often a question that comes up. Yeah. I can see you're nodding your head. And one of the things to bear in mind is that each time we've had a major financial market shock, it's something that the market has not anticipated. And so that's kind of the only way you can have a market shock. If something were anticipated or we had seen it before, the market with its millions of actors would have a way to kind of incorporate that into the way the market was behaving and the choices that investors are making. And so the fact that something is novel, like kind of when folks say this time is different, what's true about it is that it's a novel moment that's happening, that the market hasn't run into this before, which is, makes sense. We're with novel coronavirus. And at the same time, what's also true is that after every major market shock, the market has returned to equilibrium and has returned to a place where over the long run, investors have been able to experience value. So based on understanding that each time there's a market shock, it's going to be novel. And at the same time, what is not novel is that markets recover. Based on that, I was talking to this client a few weeks ago, and I said to her, we are in the game of the financial markets, and there isn't another game in town for people who need to have money that's very accessible and liquid and shows up in a bank account. There is another game in town. There's the regenerative finance game where you're investing in community wealth, and the financial returns are on the much lower end for those, and those investments are not very liquid because they're held with communities. And for whatever reasons you have that mean you need to be in the financial market and the stock market, that means that that's kind of the only game in town. And as long as we are in that game, we are dedicated to making the best possible decisions in that space. And time again, we've seen for students of history, students of economics, we've seen that winning at that particular game does actually mean staying the course. So I hope that provided some additional breadth kind of to the really wonderful core answer Freeman offered.
I think that's a really great setup for another question that's come through, which is just asking to talk a little bit more about some of these terms that we're using. And the question is, where can I learn more about the restorative model you talked about as a bridge between regenerative and extractive, and talking a little bit more about that part of what you guys kind of touched on. So thank you, Kate, for that question.
And I know I'll probably be the one who's in the best position to respond to that. Just historically, one of our wonderful partners in the social justice community is Justice Funders, which is a group that's by and for philanthropic organizations and employees of philanthropic organizations that have social justice values. They're really trying to move the needle. Justice Funders and the Movement Strategy Center, which is the network that they originally came out of, put that model together. And you put the model of extractive to regenerative kind of as a pathway for change and moving into that new economy. It's one that we've helped justice funders and resource generation adapt to looking beyond philanthropy and at the investment world. You can see a version of it that is adapted for philanthropy on the Justice Funders website. And specifically, they refer to it as the resonance framework. So if you go to their website, it's pretty easy to find. It's very colorfully illustrated as well. I'm on the board of directors of Resource Generation, and in our own firm, we're going to be coming out with more materials to help describe why what we're doing is different and what it really means to be in that restorative space. Because I think it's very important for us to understand that transitional capital on the way to the regenerative economy needs to flow somewhere, and it's not to less extractive companies that are still invested in the system. It has to be in those actors that are part of the system, but understand that impacted communities need to be leading the way in what we're focusing on when we say we're making impact.
So another question that's come through is, isn't buying when your investments are low part of a stay the course concept?
I'd love to jump in here because I wanted to follow up also on the question with Ava, because there's sort of the two parts of that. One of the strictly financial reasons for staying the course in a way is timing the market. There's no real way to know where the top and bottom and where this thing is gonna, where the market's gonna be on a day-to-day, hour-to-hour basis. And so, in a perfect world, it would be on the day that it's the highest or we have a big up day to sell. And then the next day when it falls down to buy. I mean, that would be neat. But it just sort of, like we're living in really erratic times. And kind of like Rachel was saying, the truth is that anytime there's a novel instance like this, and we talked about this on the last call, that it's almost like every decade or so, something like this happens. Like in the 70s, there was the oil crisis. There's the hostage crisis. Instances that like the market reacts very volatilely based on what's happening globally. And this is different, and the way that market behaves is somewhat predictable historically. So I guess I'm sort of, this is a two-part question. One is I just did want to follow up on that because I think the intrinsic question about do we stay the course is, can I get out? And I think as a financial planner, it's scary to say, like, when would you do that? Because we don't know when. And the other part of that is when you get out, the upswings and when market corrections happen as fast as the downturn. It's not ever a subtle thing. So it's not like we have some indication or predictability. It also comes up usually in a matter of days. And actually, if you look over kind of historically, it's usually somewhere between 5 and 11 days make high returns for the year. Like it really happens in a couple of days. So it's impossible to know when those days are. It's not usually consecutive. There's just, aside from the restorative economy and all the philosophical reasons that we stay invested, there's also strictly the financial reason that you tend to lose. like when you tend to try and time the market and go in and out, historically it's much better to stay the course because you can't predict those up days, just like we can't predict the down days. Which leads me to Toby's question about buying low. Again, yes, if we could predict the lowest day, that would be fantastic if we could all buy in. And I also would say from a financial advisor standpoint, of course we want to buy low, and there is a certain thing called contrarian buying in the industry where it's like, if you have the stomach for it, it's always a good time to buy when everybody's selling. And it's usually a good time to sell when everybody's buying, because emotionally people want, they generally want to get out when the market's low, and they generally want to buy when the market's high, and that tends to not work out. So, I think talk to whoever your advisor is, talk to whoever's, I assume that might be Nicole or Freeman or Rachel or Maya, about your certain situation. But if you have cash, generally these are historically good times to buy.
And there's a way to, thank you, Renee. That was such a really well thought out answer. Only thing that I would add to that is that there are ways to buy low in a way that is that's more systematic and puts you at lower risk. And one of the ways that we end up automatically doing that inside of portfolios is through something called rebalancing. And that's a little bit of a more complex topic, but in a very simplified form, if you were in a situation where you happen to have half of your portfolio was in stocks, the other half was in bonds, let's say your portfolio didn't do well, and let's say it went from a $10,000 portfolio to an $8,000 portfolio, and the way that happened is that stocks didn't do well, then you can imagine, without you doing anything, just because of market corrections, that you might end up with a much lower percentage. You might end up with 40% in stocks and 60% in bonds. If that's not your original allocation, then what makes sense to do on a systemic basis to get you back to the allocation that your investment strategy is originally based on would be to sell off some of those bonds and to buy some stocks to get you back to 50-50. And at the time that we're doing that with rebalancing, it always feels like cutting your flowers and watering your weeds. Like, why in the world would you buy more stock right now and sell off some of the bonds, for example, if you're trying to get back to that 50-50 scenario? And the reason why is because that's the long-term allocation that's really needed for you to meet your goals. And it also allows you to systematically engage in doing the thing that makes you money, which is to buy low and sell high, but on a systemic basis, which generally works out much better for people long-term.
We have another question that's come through the chat, which is, have we seen any evidence, or have we even necessarily been looking for it, that companies that are more restorative have a smoother financial ride during this time? And I know that that's something we've talked about a little bit internally in terms of how that part of our portfolio is affected. So I see if you could speak to that.
So one of the things that we often tell clients is that we never want to engage in kind of attempting to predict and stock pick. That's ultimately not the direction that we go. We know it doesn't work out as well for clients overall in the long term. However, what we have found in our portfolio is that as our portfolio is increasingly moving itself toward companies that adhere more and more to this restorative standard or model, what we end up with is at times lower exposure to certain things that really are part of market shocks. Very recently, a big part of the market downturn in the last month has actually been the shock to oil that's happened with this inter-country conflict around the production of oil. And our portfolio is completely fossil fuel free. So there was a part of that volatility that our portfolio just didn't participate in because we don't have fossil fuels in there. The other thing is a general belief that what is unethical eventually becomes illegal, which is and usually what ends up happening over time is that if there is a harm to the collective of society, eventually there are some who go and look to have that harm addressed with those that committed the harm. And we're starting to see it now with oil companies that are actually having lawsuits that are having far more success than anyone assumed they would have. These oil companies that are being sued based on their contribution to climate change. So those are just a couple of examples of how in the long term, what's actually better for all of us is better for our portfolios as well. One of the things I like to bear in mind, though, is that the RISE portfolio didn't exist in 2008, 2009, but if it had existed when the only rebound financial returns were available from hydraulic fracturing in North America, and that was truly one of the things that spiked rebounds, the RISE portfolios wouldn't have participated in that. And so in the short term, the portfolio likely could have lagged, right, as other portfolios rebounded. Even portfolios that called themselves socially responsible kind of changed the rules and found ways to invest in hydraulic fracturing. But because that's not something that our values and the communities we're accountable to would have allowed, those rebound returns would have lagged, for example. The RISE portfolios have been around for a little over 2 years, and so far that's not actually something that we're seeing. So far the portfolio has done slightly better than the benchmarks that we compare it to of unscreened portfolios. But it's important to note that when you put your values first, you may end up in a situation like 2008, 2009, where you have to wait a little bit longer for those rebound returns.
I can also add a couple things. One is historically, just exactly what Rachel said, there's some indication that what we call like impact investing, that in times of war, it tends to underperform a bit because we're not invested generally in weapons manufacturers, oil and gas, the kinds of things that profit during war times and tend to perform a bit better better in peace times. But the thing I also wanted to say is in 2002, when the crash of 2002 happened, that was largely to do with the tech bubble and technology companies. And a lot of people in the ESG, SRI, like it's impact restorative space, those terms are a little different, and I want to be clear that I'm using them a little bit wrong to speak to this topic, is that a lot of those investments actually didn't take the hit that the general population did because people were screening for CEO pay. So if the CEO pay was, 30 or 40,000 times the lowest paid employee, we didn't invest in those companies. And it was more about inequity. But what we found, what ended up happening was during that crash of 2002 with tech companies, they also were the worst actors across the board. So the companies that fell, like Tyco, and all the companies that performed the worst and really participated the most in that crash, we didn't own. And it wasn't because we were magic, and it wasn't because we could foresee that they were being bad actors all the way through their company. It was that we were screening for equity. We were screening for CEO pay. And what's happening in the RISE portfolio and the work that Rachel's done with forced arbitration is I think we're going to see a similar thing, that companies that are not willing to get rid of non-disclosures and forced arbitration are also going to be companies that are bad actors in many different ways. That if you're secretive and you're hiding information and not wanting to be transparent in one area, and what we're doing around gender equity is around forced arbitration, it is, I guess I don't want to predict anything, but I would be willing to bet that potentially we're going to see some of the same issues, that the companies that don't survive maybe some of this downturn, is because they were some of the worst actors in other ways.
Thank you, Renee. I agree. We end up with this restorative model of allowing the impacted communities to set the standards for how corporations participate in issues that matter in the broader world. In doing so, we end up using indicators, right, that are helpful during times of economic downturn.
You know, echoing what Rachel and Renee are saying, absolutely, we agree. And what we're realizing, and you know, something that we've always considered with RISE, is that this pandemic's impact on markets is a reminder that environmental and social problems are financial risks that companies need to manage in both good and bad times, not just in times of crisis. And our RISE strategies have included screens that measure these risks through screens such as worker protections and rights and working conditions, right? We look at companies and how they treat their employees, especially through benefits such as paid sick leave, right? Things that are really coming together and coming to head now, as Rachel framed at the beginning of our conversation. And to drill down more into specifics of what we screen for, in addition, we also screen companies based on their accounting and management practices, their community impact, and corporate governance. And so we are always looking at these, and we're prepared, right, for other crises that may happen in the near future.
Fong, I really appreciate you offering that. It's reminding me that when we have large pressures put on a system, so like on the financial system, there's this large pressure of COVID and stay-at-home orders. It starts to expose cracks in any system, and the cracks that we're starting to see in the economic system that we have is the real communal impact of, for example, private companies not giving their employees paid sick leave. That ends up being a real problem for the rest of us if people have to go to work and they're sick and they're spreading contagion in their workplace and therefore in the wider community. Underlying the move from the extractive economy to the regenerative one is an understanding of the intrinsic interconnectedness of all beings. And that's something that can be a bit easier to miss in times where things in the current economic system are running smoothly. But now those types of things are a lot more apparent. Something that I became very familiar with and that we sent out in one of our newsletters recently, you may have seen it if you're on this call, which is where we sent out the invitation for this event as well, is that there is a sub minimum wage that's allowed federally. It's $2.13 per hour for workers in certain states that earn tips. And the belief is that because they earn tips, they will be above some concept of a minimum wage. It's very frequently restaurant, food service workers. And what ends up happening with that is that some of the social safety nets we're putting in place, like as a country, like increased paid sick leave and increased access to unemployment benefits, if those are all based on $2.13 an hour, you can kind of do the math and understand that there's something inherently wrong with that. Those folks have an incentive to go to work. And when we think about it, those who are preparing and delivering our food, for example, those folks not having a living wage, not having paid sick leave, in these times of extreme pressure, we can actually see the cracks in the system. That doesn't actually work for all of us. And it's one of the reasons we really look to impacted communities to help us set our standards, because impacted communities naturally see those things and bring them forward for us. And they're the ones that are shaping the standards that we put in place for how we invest.
Thank you all for bringing up those points, because I think it speaks to something that I wanted to really highlight, which is that the way that the RISE portfolio and community not only performs during a certain time like this, but the way that it's actively working because of its nature to support impacted communities who, even in times like this, are if they're most impacted normally, they're definitely most impacted by crises like this. So just by the construction of how we make our criteria and the way that we partner with communities, they are by nature part of our consideration, and we're thinking about them now
Yeah, that's a really good reminder, Elizabeth. I want to remind all of the financial folks who are on this call. So, all of the financial folks might already be aware that there is an economic injury disaster loan that's available through the Small Business Administration. Most nonprofits don't understand that that's available to them as well. Many of the standard requirements for qualifying for that loan have been suspended, and in addition, applying for that loan, whether or not you actually take it or ultimately are offered that loan, does give you access to a $10,000 grant from the government that is not a loan, does not have to be forgiven. One of the things that we're doing is reaching out to our social justice partners to say, hey, this is available to you too. I know it's confusing because it's coming out of the Small Business Administration, but that's something that's available to you as well. Let us know if you need help figuring that out for yourselves or for others in your community. And I would just encourage all of the financial folks that are on the call, reach out to your social justice organizations that you're connected to and offer them help. A lot of us have form fear. They've made it a very simplified form on the Small Business Administration website, but still sometimes it can just be nice having a financial person on the line with you as you're trying to figure out your gross revenues, for example, if you're a social justice organization. Also, the Paycheck Protection plan that's come out is something that nonprofits can participate in as well, and there just isn't a general awareness. This is really important right now when many philanthropists and funding streams have pulled back because they're concerned about their endowments, the total amount that they're giving away. And in reality, this is the time to actually move that money outside of those philanthropic coffers and to move it actually into the hands of those that need it most and can do the most to have an impact.
And this brings up a good point as well, that like at times like these, and I think it's one thing we've been thinking a lot in terms of the RISE community, that our networks are so important. And so even if you do not directly work at a nonprofit that could use these resources, but you're connected to some really exciting groups or some partners that you really care about, or you have relationships with people at different stages of need or other networks, just sharing resources and information and really utilizing our networks right now is a really good way of supporting our social justice partners and our impacted communities, and just really building those bridges where and those infrastructures where maybe they aren't already, but that they can be informally between all of us. And we can reach so many more people and help so many more people that way.
Yeah, on that note, I would like to highlight the first link that I sent. It's from One Fair Wage, who is one of our partners that we're talking to about creating a living wage screen, and there'll be more about what that's going to look like hopefully in the next few months. But they're doing really great work, specifically with the workers that Rachel was speaking about. Tipped workers make less than minimum wage. But this link is not just for tip workers, for all workers, people in the gig economy, anybody that's really out of work and needs some relief right now. I talked to Saru, who's the director, the ED of One Fair Wage, and just I think it's useful to know that they have, as of a few days ago, had over 2 million in donations. And so I would highly encourage your friends, your family, your clients, people you work with to go to that link, because not only can you donate, it's also where workers can apply for aid. And again, as of a couple of days ago, there were over 10,000 people that have gotten some aid from that link. And they are also holding webinars and information town halls for workers that are there's over 60,000 people have been participating. So it's a great network for any type of workers, especially folks that are out of work right now.
Yeah, the folks at One Fair Wage are a social justice organization that are representing the most vulnerable of those who are impacted by COVID. So we've really lifted them up within our community, with our clients, with our allies, in order to help that fund raise as much money as possible. And we're very proud of our partnership with them. I want to make sure that kind of as we near the end of our time together, I want to make sure that there's something that's said about the enormous opportunity that is here in this moment. In this moment, we have seen that money can literally be made out of thin air. That is how the government comes up with $2 trillion for a stimulus. The bankers at the Federal Reserve make some entries in a computer. And given that we are the reserve currency, or basically the currency that the whole world uses, the Federal Reserve can do that. And so the idea that there isn't enough for all of us is something that we've seen be untrue. We can see that there actually is enough for all of us. The idea that we can't afford paid leave, either from a government standpoint or as companies, we're seeing that that's not true. That we're all individual beings that are self-sufficient and responsible for ourselves. We know that other people not taking care of themselves and staying home has a direct impact on our own wellness. And so there's also, in terms of climate, there are coyotes running the street in San Francisco, dolphins swimming closer to the coasts of Italy, and the reduction in pollution is phenomenal just from our human choices. So one of the huge opportunities in a moment like this that is so devastating for so many of us, that one of the huge opportunities is the ability to see what's possible and not to put up with the economic system as it actually has been so far, and to take our place in making a new world.
Are there any final thoughts, reflections, or questions from the community or from the team before we close up?
I'll just quickly name something if it's okay. I'm always waiting for someone else to talk, but I think it's so interesting. Speaking there, I know there are other finance folks on the call, most likely in philanthropy and nonprofit realm, but coming from a more traditional finance perspective before finding my people here at Rise, I have a pretty great perspective right now of what it's like to be talking about this debilitating income and wealth, just inequality, and the fact that we're on the call with a bunch of financial advisors talking about how we can actually truly help and save the world, versus some of my sort of traditional financial background of thinking we're talking only about markets and only about picking stocks and how this is going to affect us financially. So just wanted to thank everybody for that contribution that we're talking about. Rachel, thanks for saying, there's an opportunity here to actually make a huge shift, and recognizing that you literally just proved that there is enough for all of us, and they're truly you can make money out of thin air. You can shift the economy by just the changing of some of these great power holders. And so I think that it's inspiring and encouraging to think about what we're doing at Rise, trying to encourage these enormous companies, these publicly traded companies, these folks that are lobbying for, what business, and trying to encourage them and influence them to change is very, very cool. And it's exciting to be on this call. And I hope we do more of them. I mean, I'm a little bit of a lonely extrovert over here, so I love seeing everybody on the call.
As we head toward the end of the call, thank you, Freeman, for expressing what's in your heart. As we move toward the end of the call, I just also would like to say, just to point out that we've had such a lesson here within the Rise community, and actually just in all of the communities that we're part of, in building community wealth. I believe that is part of the shift, that in a financial sense, we've all been very focused on building our individual wealth, and making sure that we're okay financially given the system that we're in is something that's still important. But I'm really noticing us all being very intentional about building the wealth we have in a community that sees us and shares our vision for making this into a better world. So thank you for being with us in that. It's a very touching thing to be with all of you. And thank you very much to our clients, to our allies in the investment management community, and to our social justice partners that joined us for this community gathering. And we will see you next time.